how do you see macro conditions evolving as we move into 2024?
In a lot of ways, I think we're on a path, at least in the U.S. economy, from the U.S. economy, that looks what I'm calling stronger for longer. I think a lot of folks, again, if we talked at the outset, 18 months ago, thought the economy was going into an immediate recession, and we're sort of surprised to the upside as the resilience occurred. In many ways, I think early 24 is setting up in many of the same ways that early 23 set up, where there was, significant economic, economist expectations of weakening economic conditions, as well as market pricing of much weaker economic conditions. I mean, entering the year, we had something like a 1/3 probability that we'd see interest rates below 3%. By the end of the year, priced into the short-term interest rate markets. That's not, modest interest rate cuts in response to flagging inflation. That's a sharp recession akin to 2008. That's what was priced in, a 35% chance of a 2008 style dynamic going on in the U.S. economy. And there's nothing in the way of data, if you focus on the data and you look at the linkages, that aligns with that type of sharp recession in the economy. Growth is above potential, unemployment rates at secular lows. If anything, the strength of stocks, as well as the fall in bond yields at the end of 23, is creating a short-term acceleration in the economy, which we're seeing in the timeliest stats that are coming out. None of that aligns with an immediate recession. And so what we've seen over the course of the last couple of days is that pricing is starting to come out of the market. We're starting to see those bond sell-offs. We're starting to see the 2-year market move back up from the lows that we saw. And I think all of that around this recognition that maybe the U.S. economy isn't going into the recession nearly as quickly as folks expect.
And you brought up the bond market, but I want to ask you, from an investor standpoint, where do you see the big opportunities and the risks in the coming year?
Well, we're still pricing in 140 basis points of easing into the short-term interest rate market at a time when, growth is above potential, unemployment's at secular lows, and inflation's a little too hot for the central bank's mandate. Like if you just plopped me into a random time in the world and said, hey, what do you think? If you saw this set of economic conditions that are unfolding, plus the amount of financial market stimulation that we've seen in the recent period, what do you think the central bank stance would be? And my answer would be, well, maybe nothing. Doing nothing would be a totally reasonable stance for the central bank, given the set of conditions. I mean, just think about it. If you're in the Fed's shoes and you're getting growth that's pretty good, and you're getting labor markets that are aligned with what you want, and even if inflation has come down and is close to your mandate, why would you do anything? Right? You're accomplishing all of your goals without having to do anything differently. And it's sort of the natural state, unless there's a big growth crash, it's the natural state for central banks to be very slow moving. And so why wouldn't the Fed here be slow moving the way that it has been in the past?